Hello friends, welcome to our YouTube channel, The Learning CA, a channel dedicated to providing knowledge videos for chartered accountants and finance professionals. Today we'll be covering the key aspects of FTC, that is the Foreign Tax Credit Provisions under the Indian Income Tax Act. We hope this overview of FTC provisions will be helpful to you. For better and quick listening, you may reset the playback speed to 1.25x. If you like the video, don't forget to like, share and subscribe our channel, The Learning CA. Now guys, I'll just move on to session coverage. Basically this session is divided into three parts. First is the backdrop, that is the things which you are required to understand before going ahead with the FTC provisions. The credit mechanisms and methods of FTC, and the third is Rule 128 of the Income Tax Rules 1962. Now guys, backdrop, every jurisdiction may follow one or different type of one or combination of scope of taxation. There are generally three scope of taxation, that is one is source based, the second is residence based and third is citizen based. India generally follows source and residence based taxation. Then guys, we move ahead to this topic wherein there are two types of double taxation. First is economic double taxation, wherein the same income is taxed in the hands of two different persons, and the second is juridical double taxation, wherein the same income is taxed in the hands of same person in two different jurisdictions. Now today's FTC provisions discusses this juridical double taxation only, and how we can claim the credit of the taxes paid in the other jurisdiction. That is what the gist today under today's video is. Now we move ahead guys to credit mechanisms. There are certain credit mechanisms to eliminate double taxation. What are this? First is bilateral credit. So guys, section 90 and 90A of the Income Tax Act provide for bilateral credit mechanisms. This is basically applicable when the DTAA is in place between the India and the other jurisdiction or specified association. The DTAA provides for the manner, mode and quantum of tax relief to be allowed in relation to the doubly taxed income in the hands of taxpayer. So this is bilateral credit where there is an agreement in place between India and the other jurisdiction, and the credit mechanism is itself provided under that agreement. Now the other part, the other thing is when the DTAA is not available, at that time we will refer to section 91 and then we will understand the computation of claiming the credit as per section 91. There are many countries with which India does not have unilateral credit, which we will be discussing in the coming parts. Now guys, under bilateral credit, what happens? There are two types of method. First is exemption method, the second is credit method. What is exemption method? Where I exempt the income which is earned in the other country. Correct. So that is an income approach under the exemption method. The second approach is to give the credit of tax which has been paid in the other country, which is we call tax approach, and that is where there are certain credit methods. Now guys, there are two exemption methods. First is full exemption, the second one is exemption with progression, and there are four credit methods. First is full credit, second is ordinary credit, third is tax sparing credit, and fourth is underlying tax credit. So these are types of exemption and credit methods which we are going to learn ahead in this video. Now this is a value addition point guys. How do you check which method would be applicable in your particular case? Then this is the process to check the applicable method. First is we need to check whether India has DTAA with the source country or not. If yes, then we have to go to relevant income article and study that income article, and subsequently we need to also refer the elimination article or double tax article under DTAA. In most of cases you will find article number 23 or probably in certain cases 24 or 25, the elimination article, from where you can go to this method. Also we need to check that if the said jurisdiction is a signatory to the OECD's multilateral convention, then we need to cross verify the changes in the relevant articles by using OECD's MLI matching database, as also India's position in the MLI entry in force notification. So this you can check from the OECD's website. Now I'll just move ahead guys. We just move to exemption methods. Now what are exemption methods? As I said, that income that has been taxed in the country of source is not included in the taxable income of the country of residence. That is what the fundamental part of exemption method is, that it exempts the income which has been taxed in the country of source. Now in India does not follow this method usually. However, there are certain exceptions, that is under India Brazil DTAA for dividend income this method has been provided. Now there are two, as I said, there are two types of exemption method. So first is full exemption method. What is full exemption method? That the country of residence does not tax the income that has been taxed in the source country. You can check the India Brazil DTAA. Now in that particular clause number 3, you can read how you the text which provides for full exemption method, which is where a company which is a resident of a contracting state derives dividend, which in accordance with the provisions of paragraph 2 of article 10 may be taxed in the other contracting state, the first mentioned state shall exempt such dividend from tax. Now I have also given here an example. Suppose there is a B company which is source country from which the income has been generated, and that income has been paid to the resident of a I company, or to the I company which is resident in the other country. Alright. So if the dividend has been paid and tax has been deducted under the by the B company, then the I company, the dividend income received by I company shall be exempt in the hands of the I company. Okay, now we'll move ahead to the other method, that is exemption with progression. Now exemption with progression is basically the country of residence considers to add the doubly taxed income in the total income only for the purpose of determining the effective tax rate. Now how do you determine? So basically the difference between full exemption method and exemption with progression is that, guys, that basically under full exemption we don't take that income when we are computing the tax rate. So there is no tax levied, there is no income also included under the GTI. But what happens under exemption with progression is where you include that income under your gross total income, you compute tax also on that, but just for the purpose of getting the effective tax rate. And accordingly that method is if you want to check, you can check India Singapore DTAA article number 25 clause number 6. Now how these methods work? Now we have also given a small illustration for that. Now I'll just show you. If there is a taxable income of a taxpayer in his residence country, suppose it's an INR 8 lakhs, and from the source country he has got 5 lakhs. Now there are different tax rates under under the residence country and in the source country. Now what happens? How the tax is payable when the total income of the taxpayer is 13 lakh, that is 8 lakh plus 5 lakh, the incomes from the source and resident country, that will be merged under this exemption with progression method, and the applicable tax rate basis total income. So as you may see that if it was only 8 lakhs, then I would have gone with the 20% tax in a residence country, but now as the income is 13 lakh, the applicable tax rate would be 30%. So my tax payable in resident country would be 2,40,000, which is 8 lakhs into 30%. Now what would have if there was this if the same with the same facts we would have computed the tax under full exemption method. Then guys, under full exemption method we don't need to compute the ETR. It will be straight away 8 lakh into 20%, that is INR 1,60,000 will be the tax payable. Now this is what exemption method is all about. I hope you understood this part. Now I'll just move ahead. Now we come to credit methods. Now as I said, the country of resident retains the right to tax the foreign income. However, credit for taxes paid in the source state is allowed against the taxes payable in the residence country, which is what credit method is all about. That is, the country of resident retains the right to tax the foreign income, and it provides for credit of taxes paid in the source state. Now guys, in most of cases I have seen that India usually follows the credit method in most of DTAAs. Now we will see that what are the different type of credit methods along with their appropriate illustrations. So first is full credit method. Now under full credit method, the country of residence allow full credit for taxes paid in the source country in respect of income tax in the country of residence. India does not follow full credit method for giving credit to its residents except in certain cases, that is India Namibia DTAA and India Netherlands DTAA. We may see the extract from the India Namibia DTAA as well. You can also refer article 23 2 subclause 2 of this India, Namibia, DTAA. Now under this, if you just read that in India, this clause, in India, double taxation shall be eliminated as follows, where a resident of India derives income or capital gains from Namibia, which is in accordance with the provisions of this convention, may be taxed in Namibia, then India shall allow as a deduction from the tax on income of that resident an amount equal to the tax on income or capital gains paid in Namibia, whether directly or by deduction. So as you can see that this clause does not restrict any credit also, or not provides for any limitation of taking that credit. Entire tax paid in Namibia will be available as a credit for the Indian taxpayer. We will see the illustration to this. Now I have just assumed certain facts here, and accordingly I have put down this illustration. Now if there is an income which has been earned by the taxpayer in his resident country 6 lakh, if further there is an income which is earned by resident from source country which is 4 lakh, and tax paid at the rate of 15% or tax withheld in the source country is at 15%, which is 60,000. Now tax payable on overall income under resident country, so adding 6 lakh and 4 lakh, we have assumed 30% tax rate, and that is where 3 lakh is the tax payable on this overall income. Now how the computation will take place in this entire scenario? Now tax payable on overall income, as what we have computed, is 3 lakh above, and what amount of credit will be available? It is the full credit method, so entire 60,000 will be available as a credit, and the net tax payable by the taxpayer in the resident country would be 2,40,000. So guys, this is what is meant by full credit method. Generally I have also not come across such usually India does not follow this method, this type of credit method. The Indian provisions do, India DTAA maximum follows ordinary credit method, which will be which we will learn in the ensuing slides. All right. Now ordinary credit method. Now what is that ordinary credit method? The ordinary credit method is basically the country of residence allows a deduction for total taxes paid in the source country. However, the maximum deduction is lower of the following. So guys, here it places a limitation. What are those limitations? That is the amount of taxes paid on such income in country or residence, or the amount of foreign tax paid in the country of source. So whichever is lower from this will be available as a credit. So as a result, any excess tax paid in the source country, that is taxes paid in excess of taxes paid in the country of residence, shall be required to be foregone in this country of residence. Now for that particular thing, I have just given here an example of India UAE DTAA. Now what is that? Where a resident of India derives income or owns capital which in accordance with the provisions of this agreement may be taxed in UAE, India shall allow as a deduction from tax on the income of that resident an amount equal to the income tax paid in UAE, whether directly or by deduction, and as a deduction from the tax on the capital of that resident an amount equal to the capital tax paid in UAE. So such deduction in either case shall not, however, exceed that part of the income tax or capital tax as computed before the deduction is given, which is attributable as the case may be to the income or capital which may be taxed in the UAE. So the last lines are important, guys, that such deduction in either case shall not. So now here it places a restriction, it places the restriction, which is what? That however exceeds that part of income tax or capital tax as computed before the deduction is given, which is attributable as the case may be to the income or capital which may be taxed in UAE. This is how it has been worded. Now we'll see the same with the help of an illustration. So let us assume, again there are certain assumptions, that income earned by the taxpayer from resident country is 6 lakhs, wherein it has already attributed certain cost, income, etc., and it has arrived at this 6 lakh figure. Now the second part is, what is the income which has been earned from source country is 4 lakh, and the cost which are attributable to that particular income earned from the source country is 125. Correct. Now tax paid in the source country at 20%, we presume that could be a withholding tax rate, is 80,000, that is 4 lakhs into 20%. Now tax rate on overall income in residence country is 25%. Now in that scenario, how we will get the credit? So first we will compute the net tax payable in a residence country, which is that total income earned is basically 6 lakh plus 4 lakh, and then we will deduct the cost attributable to the foreign source of income, as that was not deducted, or that was not reduced from the income from the residence country. So technically net taxable income would be 8,75,000. Now as per the tax rate, 25% tax will be payable on such income, and that is where 2,18,750 is the tax payable. Now as we can see the provision that admissible tax rate would be lower of the following, that is tax payable in the residence country, and the other is tax paid in the source country. Now as you can see that technically on the income which is 4 lakh minus 125,000, on which 25% needs to be computed, which is around 68,750. That is what the tax payable is in India and in the resident country, and the second thing is tax actually paid in the source country, which is 80,000. So out of these two, the lower would be admissible, that is 68,750, and accordingly the net tax payable in the residence country would be 1,50,000. I hope this is clear. Now guys, this was under part 1. For part 2, there is a link given in the description below. You can go ahead and check the part 2 as well. Also, I would request you to join our WhatsApp communities, which is International Tax and FEMA Updates, and the other communities on transfer pricing, where I regularly post certain good updates in that particular community. So you may join them. And thanks for watching this video. You have been great audience. Please like, share, subscribe our channel if you have liked this video, the Learning CA channel dedicated to chartered accountants and financial professionals. Thank you.